Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in the markets this week and what is driving them, or more what we think might be driving them. I'm Merryn Somerset Webb, editor-at-large for Bloomberg UK Wealth. Now, my usual co-host, John Stepek, is on holiday. He's off frolicking on a beach somewhere, possibly Greece, I think. Anyway, fear not, our trusted fill-in, Bloomberg Opinion columnist Marcus Ashworth is with us today. Marcus, thank you so much for joining us.
My pleasure as ever.
I think you filled in for me a few times on my lengthy holiday in August, not frolicking on a beach and definitely not in Greece, but nonetheless away.
We talked about you a lot.
Did you?
No.
I was about to say, oh, I'll go back and listen to those, but I guess maybe I won't after all. Anyway, quite an interesting summer and so much to talk about now the summer is over. I think we're going to have to start with the bond market because it's not often it makes it onto the front page of most of the papers, but this week it has actually done that, although things seem to have calmed a little bit now. So Marcus, just in a couple of short sentences, what's going on?
It definitely is. Gilt market has dominated, you say, and hasn't been quite an exciting summer compared to most. So it's not actually a UK specific reason this time. The sell-off all year is being driven by domestic factors, politics, inflation, and a number of other different worries about upcoming budget, which you now know is November the 26th. But really, what's been happening in the last week or two is just a continuation of a much broader global, very long-end bond sell-off, driven by a number of factors. Firstly, as we know, early in the year, it was probably UK-led because we have a much increasing changing in our pension system, which means that pension funds, defined benefit schemes, do not wish to have as much exposure, duration, long-end bond exposure. Something similar is happening in Holland. At the same time, we've got a big sell-off in the second largest bond market in the world, in Japan. And just the last week or so, we've also got a bit of political troubles, not just in the UK for once, but in France, with a potential vote on September the 8th, which may see yet another French government. So all these things are conspiring with a bit of a sell-off in US Treasury bond yields, which the gilt market takes very close measure to. But this week, we've had some good news in some senses from the Debt Management Office. Quarterly gilt auction schedules and remits and syndications. And we had a very successful 10-year auction, £140 billion worth of overblown supply. But nonetheless, they sold 14 billion before we got a gilt. All great news. So it shows the demands there. This is not a UK problem in the sense of liquidity. It may well be one of solvency. We'll come onto the budget in a second. But they are going to be selling a lot fewer, more indeed, long-end gilts and particularly index-linked inflation bonds. So, the government is at least trying to get out their own way. But nonetheless, we still had very high yields. It's very worrying and everyone's got a little bit overexcited.
Yeah, let's go back a little to whether there's UK exceptionalism in here or not. So obviously, our yields have moved up fairly substantially, but the other thing to look at is whether they've moved up relative to other countries' yields. And that seems to suggest there is more wrong in the UK than elsewhere, right? So since over the last couple of years, we've seen the 10-year gilt yield move from sort of knocking around the middle of everyone else in the G7 to being actually one of the highest, possibly the highest in the G7, which suggests that people are looking at UK gilt and going, nah, not so much.
Yeah, I mean, I think that we have two problems here. We have higher inflation than certainly in Europe does, nearly double, because this government continues to do self-harming things like raising the minimum wage, raising civil servants' pay, taxing, obviously, employer national insurance, and a raft of other stuff, which has made the Bank of England's already difficult job even harder. The Bank of England, of course, is also making everyone's life harder by selling lots of its own bond holdings, quantitative tightening in the active sense, which no one else does. But then we have a fundamental solvency issue here, whereby no one believes this government's economic policy is going to work. They've not been able to get any form of welfare cuts or cuts of any form of government spending. And fundamentally, everyone's worried about more tax hikes, more bond issuance as being the only way out of this hole. So unless this government can somehow get its way around to actually doing something about controlling the runaway government spending bill, then I suspect that is why, as you said, the UK exceptionalism with a much more sticky inflation backdrop is why our yields are higher than everyone else's.
Yeah. And now we've got this long wait for the autumn budget, end of November now, where we look at this and we think, well, what will she do? And everyone assumes that this government is incapable, as you say, of cutting spending and incapable of understanding the trade-off between government presence across the economy and growth, and only capable of bringing in more and more and more taxes. So it seems, looking around, that it's unlikely that we'd find some kind of happy medium of lower inflation and higher growth.
Yeah.
So we should be nervous. We should be really nervous.
Yeah, well, I think the crux for all this is the Office for Budget Responsibility's assessment. And it's down to this nebulous concept of productivity and whether they think productivity growth is falling or rising indeed in the UK. And this is going to make a very big difference. Every 0.1 percentage point of its change, probably worse, in where it expects productivity to be, will cost about 9 to 10 billion extra for the government, for Rachel Reeves to find. So most estimates, I think he's going to have to find an extra 20 billion on top of a 10 billion headroom, so 30 billion in total to get herself back where she was in the spring statement. There are lots of different other estimates, but that seems to be consensus. But this could dramatically change if they alter the productivity growth assessment. This is really in the weeds stuff. We shouldn't be beholden to some form of spreadsheet analysis and having to change the entire government policy to keep up to this the whole time. It is madness, but it's exactly what we've got for another 3 months worth or whatever it is, then November, to find out more scare stories about which taxes are going to have to be raised to somehow make these magic numbers add up.
Yeah, I suppose one thing we could say, I mean, presumably the rest of the world, should they ever bother to look at us and think, wow, all those senior politicians keep crying on the telly. And looking at, for example, Angela Rayner's current problems, we'll only look at these through the lens of tax, okay? Obviously one of the things it says is, look, stamp duty is incredibly complicated and difficult to deal with, such that even your own housing secretary can't understand the way your stamp duty works. But given this political hiccup that the government are having at the moment, do you think less likely that they're going to go for more and increasingly complicated property taxes in the budget? Could you maybe step back and say, do you know what, maybe they'll just leave that one alone because it's a little sensitive?
I hope they don't do it. It's a simple thing called the Laffer curve, and I think they've gone over the top of the Laffer curve on stamp duty and land tax, and they need to reduce the amounts where it was working perfectly fine for many, many years. But they keep on raiding the honeypot, and now they've got a situation where clearly they've basically killed the property market. Yep. So this type of government cannot help but resist temptation not unable to resist temptation in the sense of always wanting to tinker with something. And there's too much noise in the press and various different trial balloons being floated to suggest they are going to have a look at it at some stage. I hope they avoid it. I hope they keep things simple, because virtually all the suggestions so far, if we replace one thing, they have to replace it with 5 other different things, and the law of unintended consequences.
And the worry, of course, is that they say they're going to replace something with something, and then they just bring it in and layer it on top, which is when you look at, for example, putting capital gains tax on sales of taxes or a wealth tax on more expensive houses, etc. That's just going to be ladled on top of this apparently incomprehensible stamp duty. Correct.
I don't think it's that incomprehensible. It's all I would say is that it's...
No, I don't think it is.
Going to 3 different lawyers...
Irritating, but...
Giving selective advice to each 3 of them is the reason why you get yourself in these troubles. But the rest of us, it's not that difficult.
Okay, now, apart from property, the biggest pool of available cash in the UK is in pensions. And we just talked about how possibly one of the reasons why gilt yields are rising is because the pension industry no longer wants to or needs to hold quite so many long-dated gilts. But put that aside, that's still where the money is. So if you were the Chancellor, and if you were the current Chancellor, maybe you'll be the one delivering the budget, maybe you won't be. But nonetheless, if you're looking for money, that is where the money is, right?
Yeah, and I think there will be changes to the amount we are allowed to put in each year. It's currently 60,000. It sort of slightly oddly went up from 40,000 under Jeremy Hunt. I think they may almost certainly I think they'll reduce that. At the same time, the 40% or 45% tax break, I suspect they may want to blend that with the lower rate tax at 20 and perhaps go for one rate of, say, around 30%. So I definitely think they will reduce pension benefits. In some sense, I don't think it'll alter how many people will save. I think most employees will still put 30% in rather than the 40% they were maybe enjoying. It's not a very nice way of doing things, but I think it's a very easy one. And because it's already bedded in the system and all you're doing is changing the rate and changing the amount you put in, I think it'll be an easy one. And they can also very easily brush it off as a type of thing Labour government would do, making it more advantageous for lower income people. What
about the amount of money that people can withdraw tax-free? I mean, that's one that we know some of the people inside the Treasury are very unhappy about, that you can still withdraw well over £250,000 tax-free from your pension. Seems that would be a pretty easy way to raise money, take that down to 50. I mean, obviously everyone's going to hate you, but, raise a reasonable amount of money.
I think they'll avoid that one. I think that's harder than it looks. As you said, it would be viewed egregiously unfair. You put all that money into a pension, you should be allowed to stick to the rules. What you put in the future is changed. That's a different story. But being aggressive and taking away or something you were allowed to do on Wednesday and then on Thursday you're not allowed to do it, I don't think they'll do that. I hope they don't do that. I think that's very unfair. Having said that, I have made sure I've taken mine out just in case.
Have you? Interesting. Yeah. Now, the one thing that's happening with all this gilt market or bond market turmoil around the world is that the gold price has gone berserk, something we've been telling people is going to happen for nearly 30 years now. And here we finally are, success.
Yeah, we've broken up. It should continue to race higher. I note this time round, it's silver's going with it, possibly even leading it, you could argue. But, look, this is just a symptomatic of we got Trump tariffs possibly getting ruled out and what happens in place if that was the case. You can see why, central banks allegedly, I'm not sure how you can really trust this data, but they now hold more gold than they do US treasuries. This is a long-standing trend, and look, I think there is not much to suggest that gold will not continue to do exactly what it's been doing for the last year or more, and it will probably continue to head higher as this world gets more complicated and confusing. And indeed, people are looking at stock markets at all-time highs and thinking that doesn't make any sense with bond yields this high, because normally you would expect that would hurt equities. Maybe that comes at some point.
Did you take that money you took out of your pension and shovel it into gold?
I've spent it all, a whole lot of it. I have put it in other things. Some of it's silver, but not enough, clearly.
No, never enough. Never enough. For years and years and years, you talk about gold, you tell people about gold, and then when it actually happens, of course you don't have enough gold. But as you say, it does have interesting implications for the UK stock market as well. And of course, mid-caps, smaller caps had a fairly lousy beginning of the week. The FTSE 100 still looks absolutely fine, but nonetheless, if you're getting to the point when you can get a better yield from a bond than you can from an equity, things do begin to change, don't they?
Yeah, well, that's a very interesting point. I mean, if you think about it in annuity terms, which we always used to be forced into doing with our pensions, these yields are very attractive. At some point, people are going to realize that this is a great opportunity to, lock in 5-point-something yields, and in a sort of a tax-efficient way, it can be even higher. Yeah. That is making more sense. And I don't know why we don't make more of annuities and make it better regulated, more visible, and more competitive. And I think that's something this government could do to help if they wanted to do something positive towards the pension industry.
What's the end game, do you think, Marcus? I mean, here we are. We talk about the fiscal problems of the UK. We talk about rising gilt yields. We talk about the gold price, etc. Is there any way that we can pull back, or Reeves can pull back from the brink? Or do we look forward and say, actually, things are going to get really nasty over the next few years?
Well, I'm not too pessimistic about the UK economy in the context that what this government is doing, which is not great, is they're shifting and all the spending into the public sector away from the private sector. But the private sector has actually been fairly resilient, or more resilient this year than we could have and should have expected. I do believe the Bank of England will have to lower interest rates, which will in theory help. And I think that we are destined for more than 1%, but less than 2% growth for the foreseeable. But that isn't the end of the world. We don't have the worst debt to GDP, though some people think we have. We are not going anywhere near the IMF. There are all these shock stories about the IMF is failing to understand a couple of things. One, our economy, 6th largest in the world, 3 trillion more, is too big to bail out. The IMF doesn't have the firepower. It's not the right type of crisis. The IMF last time bailed us out more because we had a foreign currency crisis and a sense of current account deficit issue, which we still do to a degree, but not to quite the same extent. We are on our own in the sense that France is even worse predicament, but at least it has Germany to bail it out. Again, I can't see France.
The IMF can't bail out France either.
And it wouldn't be able to, and it wouldn't want to. That would be up to Germany, I'm afraid. But they can't bail out either of these huge economies, and nor could they. They're the wrong types of crisis. There's nothing the IMF could suggest or do which would help anyway. So the point is that we have to stop government spending rising at the level it is. That is what has to break. And this government has to realise it, and will unfortunately realise it sooner, hopefully, rather than later.
Well, that will be interesting. It'll be fascinating to see what drives them to actually realise that and start doing something about it. I'm slightly less optimistic than you. But Marcus, anything else we should say before we finish up?
No, I just think that this is unfortunately going to be a long, drawn-out autumn with ever more scare stories on what taxes, wealth taxes, and various other different things are going to come out. And it's so unnecessary. I sincerely hope that the Bank of England stops its active quantitative tightening policy. We'll find out that on September the 18th. Hopefully the Federal Reserve will have cut interest rates by then, and hopefully that means the Bank of England itself will start thinking about that in November. And then maybe, just maybe, we'll be at a slightly better stage if the OBR gives us a reasonably optimistic outlook on the economy.
Brilliant. Thank you. Thank you, Marcus, and thank you for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. And Marcus is at Marcus Ashworth. This episode was produced by Summer Sadi and Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.